Okay, why don't we get started? I want to welcome all of you to this fireside chat with our distinguished guest, Peter Fisher. My name is Andrew Lowe. I'm a faculty member here in the finance group. And before we begin, I want to thank the MIT Laboratory for Financial Engineering and the Golub Center for Finance and Policy for co-sponsoring this event. I want to thank you all for coming on a evening and cold outside, but warm in here, and lots of interesting ideas that we're about to get into. And I have to tell you, it's a great honor and privilege for me to be having this fireside chat with Peter, somebody who I've known for years, learned a great deal from, is in the perfect position to discuss the topic at hand, which is where will the Fed go, and what does that mean for the rest of us? Peter comes with an extraordinary background. He was Under Secretary of the Treasury for Domestic Affairs. He was at the New York Fed for a number of years and held a number of senior positions there. Then he had a very successful career in the private sector at BlackRock with a number of positions. And now he's a senior fellow here at the Golub Center for Finance and Policy. So please join me in welcoming Peter Fisher.
Thank you. Thank you, Andrew. Great treat to be here, both here today and here at MIT this year.
So Peter, I want to start with a talk that you gave a few weeks ago at the Golub Center. Not sure if everybody went to that talk, but for those of you who haven't, it was a rather sobering discussion of the untethering of fiscal policy from pretty much all spending and responsible kind of decision making, really quite a dire picture. And you know, we've had conversations before about the fact that our national debt is growing to unsustainable levels, but you really pointed out some very different things about what was going on and what has been going on in the macro economy. So I was wondering if you could basically reprise your main themes from that talk, because there are a whole bunch of things that lead to where the Fed is going to be going and what that means for the rest of us.
Yeah, sure. Let me give that a try. I'll go back when I was Under Secretary of the Treasury. I gave a speech which generated some notoriety. So 23 years ago, I described the U.S. government as an insurance company with an army. And then I tried to explain that it actually wasn't an insurance company at all, because it did its accounting on a cash rather than accrual basis, therefore obscuring all its forward liabilities. And therefore it was really an accident waiting to happen. And a number of my friends quickly sent me emails or phone called me asking me if I was looking for a job away from the Treasury. They were so confident I would be fired by the White House for explaining quite so starkly our nation's fiscal position and how the negative position we were then running. I was trying to draw attention to an accrual accounting report we created, which showed tens of trillions of dollars in a negative position, balance sheet position of the federal government. But with hindsight, what's really amazing is, like others, I was so wrong. It wasn't an accident waiting to happen, or it didn't happen over the last 20 years, even though I thought a $3 trillion deficit looked like accumulated debt, looked like a big number. So one of the things I did in that talk was reflect on why was I so wrong? And I was wrong, I think, because I missed two things. I missed the unrecorded asset the federal government has, written into the Constitution, in the form of an option to tax the economy at a higher rate in the future. That option has immense value and is rather a tricky thing for the bond market to try to price. Someday, fiscal prudence might prevail. I'm going to keep digressing, and you can interrupt me if I digress too far. But just a handful of years ago, everyone thought the state of California was as bad as Greece because they couldn't pay their bills. And a lot of bond traders around the world thought California is as bad as Greece. And California literally was paying its debts with script. That is, that they couldn't borrow any more money. They were issuing sort of
I remember that.
bits of paper. And I tried to persuade, and I did persuade a number of the portfolio managers at BlackRock who were working for me at the time, that actually that was a silly comparison. the Californian economy is the 6th largest in the world and one of the most beautifully diversified economies on the planet. Silicon Valley, Hollywood, agriculture, heavy industry, all sorts of things you'd love to have, and Greece doesn't have much more than tourism. And so all you had to get was some politicians to organize taxes a little better, and California's fiscal house would be put in order, which is exactly what happened. Now, I don't know that will happen in the United States, but that might happen. That's the option. The other thing I think I missed 25 years ago was the importance for fiscal sustainability of having a competent central bank. And we could go dwell on that for a while. But we maybe come back to that. But the talk I gave a few weeks ago was trying to point out that if we want to have a more sustainable fiscal outlook, we have to distinguish 2 ways of thinking about this. One is, can we stop borrowing so much money? That's up to Congress. That's a matter of political will. And you can't look anywhere else to solve that. You have to look for Congress. And if our fiscal policy is untethered, revenues and outlays seem to have no coherent relationship. Alan Auerbach at USC has written eloquently about how you can't find a fiscal signal in Congress's behavior anymore. As the deficit goes up, Congress doesn't do anything. And prior to around 2000, you could always find a little bit of a signal. It's untethered, and that reflects our untethered politics. And you can't expect Congress to have a sensible fiscal policy and connect revenues and outlays if they can't talk to each other about much of anything. The other way we think about fiscal sustainability is hoping for something to come along. Higher growth, higher inflation, higher interest rates. Something like a deus ex machina will descend from above and make everything better. And one of the things I tried to explain is that's not very likely. Higher growth in the abstract could help us pay for our debts better, as long as the politicians didn't cut taxes again. But for the last 25 years, every time the economy's grown more quickly, political will has been to tailor it back. And we essentially collect about 17% of GDP in taxes and spend about 21% of GDP in outlays, and that's a 4% gap. And it's just been embedded for the last umpteen years. Higher inflation is a possibility. We can imagine we inflate away the real value of our debt, but you have to imagine everyone's a sucker for that. Or you have to imagine financial repression could trap trillions of dollars in assets inside something, and people wouldn't know how to price it better. And that's happened in the past, and it's happened in foreign countries, but we've shown a sad tendency in the last 20, 30 years not to be able to put much of a ring around our banking system. And our capital markets are going to make it very difficult, especially in their crypto generation, to try to trap trillions of dollars of debt in negative yielding assets. So I don't think that one's very high. And the third possibility people think about is, well, higher interest rates will intimidate the politicians, and that will make them behave. That requires political will. But imagining the bond market vigilantes, which we talked about in the 1980s, will come to our rescue, is actually to misunderstand who they were. In the 1970s, our bond market, the yields, the nominal yields on Treasury debt traded at and sometimes below the rates of inflation. The bond market takes its lead from the Fed. It doesn't have a separate view of where we're going to be in 20 or 30 years. And so bond market vigilantes were conjured into existence by Fed Chairman Paul Volcker, because in the 1970s, no one believed the Fed would squeeze inflation out of the system, and they were right. The Fed wasn't going to do that until Paul Volcker came along and changed their expectation. And so for interest rates to get high enough and threatening enough to intimidate the politicians will require the Fed to convey to the market a reaction function that would be that vigorous. And that's not yet on offer and is not likely to be with President Trump. So that's my rather gloomy talk I gave a few weeks ago at the Conference on Fiscal Sustainability. But the one ray of hope is a competent central bank helps you get out of this. We don't normally think of it this way. We think the central banks over there doing monetary policy, and the treasuries and the administration and Congress are doing fiscal policy. But actually, central banks were invented to increase the sustainability of the king's debt. The kings were borrowing too much money to fight wars, and it was kind of lumpy and didn't work very well. And the Dutch and the Swedes and the English figured out how if you had a bank that could take some of the debt off the market and would trade it in a liquid way, you could make the debt more liquid. And that's actually the origin story of central banking. It's really only in the last 80 years that that's a 300-year history of central banking. The last 70 years or so is where we think about monetary policy as this discrete thing off to the side. That's a long, but there's a little summary of what I spoke about.
No, that's great. I was hoping that you'd summarize that, because my next question is to try to put this in terms that even I can understand. I am no macroeconomist, I have to tell you. I'm a financial economist, but I've studied enough macro to be confused about what's going on. And by the way, I should say that I'm amazed that you are not an economist by training. I mean, you certainly are an economist. You've done more economics and you know more economics than most economists I know, but you were trained as a lawyer, am I right?
Yes, I went to law school. Yes, I did. I studied economic history, I will allow, but I had a pretty good training at the Federal Reserve in economics.
It served you well, because you can use the economic history to your advantage in this case. So let me make sure that I understand from my more naive point of view. We are spending, in this country, we're spending more than we are earning. The amount of money that we're generating, the amount of tax revenues that we're generating, is really not keeping up with the amount that we're spending. And so we're borrowing more and more and more.
Yep.
And the Fed can either facilitate that borrowing, or they can push back a bit and say, no, you have to be a little bit more disciplined. And so you have this notion of, is it called fiscal compliance or fiscal capture?
Fiscal dominance.
Fiscal dominance.
There are others, not my turn of phrase.
Okay.
John Cochrane at Stanford and others are
So the idea behind fiscal dominance is that at some point, if the Fed caves and basically becomes an instrument of the government in terms of facilitating its borrowing, you're going to have much more serious problems.
Yes, I'm not going to put a number or a date on what I called the moment of absolute fiscal dominance, to be clear. We've watched Japan for the last 30 years, and we have a sort of, we have to, like a dog, sometimes tilts its head and doesn't quite know what it expresses uncertainty. So if you have deflationary conditions that are otherwise given to you by your macroeconomy, and then you have the government keep borrowing money, more and more money. The Bank of Japan actually bought a lot of government debt, and it wasn't very inflationary. Now, the present moments may be changing that. But we went on for 2 decades in which the Bank of Japan kept monetizing the government's debt and didn't seem to create a hyperinflation. It definitely did not.
But Japan had a very, very slow growth for a number of decades.
Yes, and that very slow growth is part of why there was a deflationary impulse.
Right.
It seemed is one reason we would think of that. And so the Bank of Japan did something else, which it went and bought huge slugs of Japanese equities. So we look at Japan and we see 240% debt to GDP. That's gross, not net. So it's more like 150 once you take into account all the equities they bought, which is a little crazy. But so it matters whether you have an inflationary or deflationary backdrop. But if you have an inflationary backdrop and the government keeps borrowing more and more money, and that creates a bigger and bigger fiscal impulse of spending at the same time, and now you have inflation, most of us believe there'll be a moment of fiscal dominance where the central bank is just by its own objective function, just has to keep buying the debt to try to stabilize it, and that itself creates a hyperinflation. And Argentina's gone through this for 60 years, in different forms. And Turkey's gone through an episode pretty much like this in the last 7-8 years.
Okay, so what about the idea that because the United States still has the reserve currency of the world, maybe not as much as 12 months ago, but we still are the reserve currency, we can still borrow from our international neighbors. Is that something that would essentially give us more rope to hang ourselves before there's any kind of fiscal discipline that gets imposed?
Yes, it definitely, the global imbalances we have, that other countries are selling us stuff and we're buying it and we're printing money to buy it, and then they have dollars which they invest in our treasury securities. That global imbalance allows this game to keep going longer. There's no doubt about that. How much longer? I don't put a date on that. I think I'm emphasized the difference in the Japanese experience, because if we tip to an inflationary, accelerating inflation here, then it's very different. Mm-hmm. And that's when the central bank would have to raise rates. Now, there's a rhetorical issue. Many of you were too young to know, not all of you, that a generation ago, Paul Volcker was very stern with Congress. I cannot slay inflation by myself. You must slow the rate of spending and borrowing. And for the last 15, 20 years, the central bankers have been more squeamish about that. They haven't lectured Congress about you have to do your part. Now, that's a little nervous-making, because it's quite, many of us will look back at the burst of inflation we had in COVID, when the Fed was warned and Congress was warned that if you do all the spending President Biden wants, you're going to create inflation. And they said, no, it won't. And yes, it did. So that was a fiscal push that created an inflation. And so if we get that, we could get that kind of, we've seen it recently. So that would be the occasion where you'd want the Fed to push back on Congress and say, and the administration, no, you've got to slow the rate of spending.
So that's a good example. I was going to get to that, because it seems certainly that when we started seeing inflation to the tune of 20 or 30%, which was a very short burst, understandably, but when we came out of COVID, we had some pretty striking inflation. I believe that kind of freaked people out. Mm-hmm. And in particular, it freaked the Fed out and it freaked Congress out. And ultimately, we were able to pull back a bit from the brink. Do you see that as a possibility? Or is somehow this untethering different this time? Is there something that's given you more concern than the abilities for the economy itself and the political system to work in checks and balances?
That episode doesn't, Congress's current fiscal posture of cutting taxes and increasing spending doesn't give me a lot of confidence. Yeah. However, how annoyed the American people are with the cost of living, I think, that's certainly a warning shot to the political class, that it's not an open-ended license to keep borrowing and spending. Yeah. So that's slightly optimistic to see that. I think it's something very subtle you might want to observe is there are all sorts of surveys of inflation. If you read the fine print or look at the surveys themselves, some of them ask about inflation per se, and some of them ask about how do you feel about the cost of living, which is a much subtler question to ask a household. Mm. Can involve, it's not whether the price of eggs went up 3 cents, it's whether I'm pissed off that my neighbor seems to be doing better than I am. And it's a much more complicated set of emotions come to play when we survey for the cost of living. Anyway, I hope that's...
someone once said that if you want to really make somebody unhappy by giving them $1 million, it's a very easy way to do that. To give your neighbors $2 million. So that's definitely an issue. But so I want to get back to the theme here, which is what do we expect from the Fed? So a point that you brought out in that previous talk was that there is this moment, kind of an inflection point, where it becomes a much more serious issue, and it's hard to walk back from it. And there's a difference between competence of the central bank and the independence of the central bank. So can you talk a bit about that? And then we're going to have a new central banking president soon, in April or May.
The chair of the Fed will be, President Trump will have the opportunity. What everyone gets wound up about the independence of the Fed, and all sorts of surveys, and they try to, they all boil down to making it binary. It is or it isn't independent. And that's, political economy doesn't really work that way. I mean, I spent 17 years in the Fed, and we were all understood that we were independent within the government, not from the government. You couldn't quite claim that, well, we know nothing about the federal. No, we're an instrumentality of Congress, and so you're independent within a certain structure. I think the central banks can make mistakes. The Fed made a mistake in 2022. The Fed made terrible mistakes in the 1970s, and then they created great inflation. And you can try to pass it off on a loss of independence, but some of it's a loss of judgment. And the 1970s is an interesting episode in which, yes, the Nixon administration was trying to limit the Fed's independence, but Arthur Burns made plenty of his own mistakes. So I just, that's the distinction I was trying to draw. And right now, the Fed clearly has a very difficult cyclical challenge ahead of it. The tariffs and what the pass-through of inflation is going to be into the economy. We could digress into that for a moment. And then President Trump seems to demands lower interest rates. And he's going to get a Fed. And the Fed may be lowering interest rates anyway for cyclical conditions. The economy may be quite weak. Let me digress a little into how odd the cyclical position is. A lot of weakness coming through from uncertainty. You see a lack of business fixed investment other than in the AI boom. You have this massive AI boom. One sector of the economy. It's beyond what the housing sector was 15 years ago in terms of its dominance of what. So that's one strand. I mean, it comes through power and building data centers, and then you have this weakness coming through from the rest of business fixed investment, and then with the income inequality, a lot of evidence, and the Fed's minutes today display this, that you see consumption's pretty strong among rich people, but not at all strong among most of the income distribution. So that's a lot of fragility in the economy, and the Fed is facing that. But now we have to see whether inflation pass-through accelerates. There's been this endless back and forth argument about are tariffs inflationary or not, or are they taxes on the American people or not. Ultimately, of course, they're taxes on the American people. But some subtler work I've seen by some colleagues at the Peterson Institute, where I'm on the board, says actually, in the first instance, the exporter to the United States can suffer the consequences of it. If they want to maintain market share in the US, they cut their prices. So you actually have to think about how the tariff hit is divided between the exporter, the importer, and the consumer. So the exporters seem to have taken some of a hit, the importers have taken some of a hit, and only a little bit has passed through to the consumer so far. But that's not, Alan Greenspan taught me, corporations defend their margins. That's their preferred habitat. They're not going to let their margins be decayed if they can do something about it. So they will try to raise prices when they can. And the foreigners can't take it, the exporters can't take it. So I think the better forecast is going to be we're going to see more inflationary pressure coming from the tariffs if they're sustained. But then there's the chaos and uncertainty the tariffs have caused.
So let me just pause briefly to talk about the tariffs. No. This is very, very interesting. So we've now had a few months of experience living with tariffs and the threat of tariffs and the rollback of tariffs. Are tariffs an issue at all? I mean,
for whom? For what?
Well, for the macroeconomy. I mean, do you think that central bankers right now are concerned about tariffs? Because I can tell you that Wall Street is not. There are some tariffs now out there, but they're generally small, and in most cases, the exporters have absorbed the price increases. So we haven't seen tremendous inflation. We have seen a reduction in trade. That's confirmed. But do you worry about tariffs yourself at this point?
Yes, we know that tariffs, if sustained, which we don't know,
Right.
will decay the productivity of the affected industry.
Yep.
It's not complicated. You can think it's been nice. No, the steel tariffs Trump put through in his first term, you can see the decay of the productivity of the U.S. steel industry. And the one thing we know we need more of is productivity is where growth in the economy is going to come from, especially with a stagnant population, a slow-growing population. So the medium term, yes, tariffs worry me because I know what they do to productivity. I know what they're doing to business uncertainty outside the AI.
Yep.
So you can see the decay in investment coming through there. Yep. And so, yeah, now, but finally, you can say, and central bankers do, oh, not to worry, tariffs will be one-off. Well, not if the Fed accommodates them. Then they pass through, and then no. So the Fed is tight enough to offset them.
Yep.
Then they could be one-off, but not if the Fed is easing, just as we're experiencing rising price pressures.
So I'm going to turn it over to the audience in a few minutes, but I have just a couple more questions for you that I just can't resist. So you also brought up the stock market and growth and AI. It's a very strange situation that we're living in right now with the stock market because it's high. I mean, the S&P is at 6,600. But what many financial economists find kind of astonishing is that if you take a look at the market cap of the S&P 500, 35% of that market cap is the Magnificent Seven. Seven companies make up a third of the S&P 500. It's pretty extraordinary. And so on the one hand, it looks like everything's great, right? The stock market is up. But then you look at the price of gold, which is usually a bellwether of disaster and hyperinflation, all that kind of stuff. When people start buying gold, that's generally not a good sign. Gold is at an all-time high of like $4,000 an ounce. So if you're sitting at the Fed, what do you make of all of this? You don't want to do anything to trigger a market crash, but if there's ever anything called irrational exuberance, I think that was the Alan Greenspan term, it kind of feels like we have it right now. So if you were sitting at the Fed, what would you be thinking and what would you be preparing for? A market crash, or do you believe that this kind of growth is going to somehow dig us out of the hole that this untethered fiscal policy has gotten us into?
I mentioned this. I'd be very nervous about the single sector. Now, around 2005, I was helping run fixed income at BlackRock. More than 100% of the job growth of the prior decade in the United States at that moment was in healthcare and housing. That is, the rest of the employment of the economy in that part was like shrinking.
Wow.
That was and healthcare just grows all the time. Healthcare always grows faster than GDP. That's a different problem.
Need our drugs.
Yeah. But that meant that housing, putting healthcare aside, housing was growing faster than the rest of the economy. That was a real sign of a bubble.
Yeah.
That was like, no. The rest of the economy is shrinking its employment, and housing just keeps growing like a monster. And that feels a little what's going on with the data rooms and data centers now.
But
and so it's the dependence on a single sector.
Yeah.
Which makes me think, oh, whoa, if I trip over my shoelace, I'm going to get a bloody nose, and it's going to be a pretty bad one.
But do you think it's the job of the Fed to try to time that bubble and burst? Or
No, you have to be worried about what it means about a recession.
Yeah.
How exposed we are to a recession. No, I don't. Now, Alan Greenspan, bless him, he's still with us. He was often criticized for being asymmetric and always offering the Greenspan put and always trying to bail out the market. I've written and published this. I think that's a bad rap, and people have selective memories. In the early 1990s, he kept rates really firm, and he destroyed Drexel Burnham Lambert and the entire savings and loan industry in America because he was worried about inflation. And in 2000, after the NASDAQ turned, we held rates firm for the entire year while the NASDAQ lost 50% of its value. That was no Greenspan put. And I'm pretty confident, even though he never said anything about it or wrote anything about it, that he was trying to suck the air out of the dot-com bubble. He didn't want it to come back. Now, those are difficult judgments, you know, and chairmen of the Fed get to make them. Now, it's hard. I don't think it's a good thing for the Fed to say, I'm going to go prick a bubble. That's not on purpose. That's why I emphasize the sensitivity of the economy just to a single sector is worrisome.
Yeah.
I put it that way.
So let me ask you one last question, and I'll turn it to the audience. So what do you think we ought to expect then from the new Fed chair? First of all, do you have any favorite candidates that you would like to share with us about who the new Fed chair might be?
I don't have any inside line on
Okay.
who the next Fed chair would be. If you've read the papers, that's all I've read.
But what do you think is in store for us under that new chair leadership? And what does that mean for everybody in this room?
Well, I think the new Fed chair is going to have a hard job. I said cyclically. This is just an awkward moment, even putting aside the difficulty the president might cause for you because of the uncertainty about a single sector of the economy, the tariff pass-through. I say that's a hard job cyclically. The Fed hasn't yet reconstituted, it doesn't have a central agreement on how monetary policy works post the recent inflation burst. That's got nothing to do with Donald Trump. They just haven't done the hard work, and Secretary Bessent has written about this quite eloquently. He hasn't suggested what they do about it, but he's pointed out they really haven't come up with a new MO for monetary policy post-QE, post-inflation of COVID inflation. So that's another challenge the next Fed chair is going to have. They put through a strategy of asymmetric. They were going to be asymmetric, and that didn't work. And that let inflation out of the bag. So they're going to have to rewrite their strategy. And then you have a president who's going to want you to use interest rates to stimulate the economy to get reelected. So the next Fed chair is going to have a really hard job, whoever it is.
And do you believe that they'll be able to maintain the independence that you argue is so important and valuable?
I don't know. It will be very difficult. It's not hard to see that most people who work for this president are on a short leash. The Supreme Court's going to have an opportunity to see if they extend the independence they offered the Fed in the independent agency cases they've been reviewing, and in the Lisa Cook case. So maybe the Supreme Court puts a little leash on President Trump, then the next Fed chair will have a slightly easier job, but still a hard job on the substance of it. And so I think there's a lot of hot air and ink that's been spilt over what caused the stagflation of the late 1970s. How it was we got both a weak economy and high inflation at the same time, which it's not supposed to happen that way. And there's some economists about a decade ago who did some very nice work looking back and saying, it really wasn't that complicated. It was about 2 recessions back to back and with different lags. That is, the inflation hadn't come out of the economy from the first recession the Fed caused. Inflation was still high. The economy did badly and then started accelerating again, but it hadn't recovered the employment. So there are different lags that take place from changes in unemployment and changes in inflation.
Yeah.
And then you ended up with the different lags, you ended up on both high at the same time.
The W recovery.
The W recovery and then different lags. Yeah. And so there are all sorts of, I don't think stagflation is something that's baked in the cake, but certainly can happen. And that makes the Fed's job even harder. Anyway.
That's a scary thought.
Questions now.
Okay, yes, please. Questions.
Thank you so much for being here, Professor Lowe and Mr. Fisher. My name is Calvin. As you mentioned, right now the stock is very high, and also the economy is kind of like a stacking. My question is, this leaves the Fed in a dilemma that raising interest rate or lowering interest rate might be a difficult decision to make. Do you still think Fed operates as a normal institution that can help the economy to grow, or sort of like regulate the overall economy? And then my follow-up question would be, if there is a recession going forward, what are some of the tools the government have to deal with the future recession? Thank you.
Well, the Fed is always struggling, or any central bank, to balance three things at once. They'd like to have growth as high as possible, they'd like to keep inflation under control, and they'd like to avoid financial instability, too much destruction of asset values unnecessarily. Let me just call financial stability by that name. And so they're always trying to balance that, and that's always a difficult judgment. I think if the economy is clearly in recession, it's not complicated what the Fed does. The Fed lowers interest rates. Now, how quickly that would heal corporate or household balance sheets is a question about how sensitive we are. We used to be much more sensitive to changes in interest rates than we may be today, especially corporate borrowing. I don't think there's no corporation in America that's not borrowing today because the rates are too high. So you could cut it, and maybe there'd be a little more business fixed investment. Maybe there'd be a little more housing. So there's a question about the response, but how the Fed responds is quite clear. Now, we have all sorts of, Congress loves to spend money if there's a recession. Now, that's with the high level of debt we have, that would be awkward, but it's also not complicated. That's generally a good idea. We want to, if interest rates are falling and the economy is in recession, we have a lot of countercyclical fiscal stabilizers, some which come in automatically and some which take place by virtue of politics. Congressmen like to do that. I think the difficult thing will be if inflation keeps creeping up and the economy is still fragile. Then the Fed has to keep raising rates, even though it's not trying to puncture anything. Now, there's another school of thought, one I haven't mentioned, which is, imagine how strong our economy would be if we didn't have all the tariff uncertainty the president's created. The economy was doing really pretty well a year or two ago. There was pretty strong demand, pretty strong sentiment, and so maybe the economy turns and picks up speed here. What Andrew said about, Wall Street's not frightened by the tariffs. So that's part of why I say it's a very subtle judgment. But I don't think it's hard if we get a recession what the Fed lowers interest rates. For entertainment value on financial fragility, I'll just say that when Alan Greenspan became chairman of the Fed 40 years or 30 years ago, I'm forgetting, 1986, 87, 86, I guess. He made us all at the Fed write a doomsday book of all the things that go wrong in the world. This could go wrong. An earthquake could hit Tokyo, a recession could hit the United States, or something could hit the. And we imagined all these scenarios, and they were all, I wrote several of them, beautiful pieces of analysis, and the concluding chapter was always, and then the Fed lowers interest rates and lends a lot of money. And so we had these exquisite pieces of analysis about geopolitical risk and the Berlin Wall falling and whatever, the Russians invading Western Germany, and no, the Fed does the same thing. It lowers interest rates and it lends freely. So the Fed knows what to do if called upon. Next question.
Yes, here. And then over there.
So thank you very much. And I have a question for you about something you said earlier that's not intuitive to me. So you mentioned that when you have tariffs, it reduces productivity. Can you talk a little bit more about how that mechanism works?
Yeah, so the industry that is protected, it's not a universal. So we take the steel industry, and we're going to offer it tariffs, which means its foreign competitors have to face a higher price. Now the industry has a pretty simple choice. We can price up right under our foreign competitors and extract that rent from our clients and pay it to our shareholders, or we could invest harder and become more productive, but we don't have to do that because look how much money we can make by just pricing under the umbrella. So they don't have an incentive to become more productive, and they don't. Their productivity declines. It's worth a digression here. I was in the Bush administration when, in 2002, we raised tariffs on steel. And you'll recall the episode a few weeks ago where the province of Ontario ran TV ads reiterating Ronald Reagan's comments about how opposed he was to tariffs. And then it was pointed out, well, he did that right after he'd raised a tariff. So I wasn't in the Reagan administration, but I can tell you exactly what went on in the Bush administration in 2002. We all went to a conference room in the White House, and someone said, please don't make any mistake. We're raising tariffs for steel for West Virginia. It's about the electoral college. It's not about economics. We don't like tariffs. We're not going to do it for any other industry. This is a political calculus. Don't be proud of this. Don't go around bragging. We're going to try to get past this. It's about politics. And that's because tariffs, and you can see this, the current Trump administration getting into this, you think you do someone a favor and you piss off somebody else. So you raise this tariff and it helps that industry, but the people importing it and paying for steel are upset. And you try to buy some beef from Argentina, but the ranchers in the US are angry. And it just is a mess. And you can't please everybody. So that's in addition to the problem of it lowers the productivity. It's a political economy nightmare because you know you're going to piss somebody off when you do too much of this. And now you see President Trump trying to lower the tariffs on bananas and coffee, and it's too complicated. I hope that answers your question. Sure. Mm-hmm. Yeah.
Hi, there's been a lot of talk about the loss of faith in the independence of the Fed and perhaps the integrity of the actions that the Fed can take. There's also been this movement recently about loss of faith in like the data and reporting that's been happening in the United States. I'm thinking of like the job report that Trump bashed a couple weeks ago. Do you see this having a big effect on what the Fed can do or the market's reaction to what the Fed does?
I don't think the Fed's independence has been challenged yet, although the president clearly has it in his power to do so. Just if you want to, I mean, it's a spectrum. There's a little less and a little more. So I don't think that's yet happened. On the data, again, I would say the same thing. I don't think it's yet. Actually, I don't think we're yet now. Let's separate. The president was upset about a data release. He fired the head of the Bureau of Labor Statistics. That's not a good precedent. That's bad. I don't think that alone made anyone question the data. Now we have something else. We've had a government shutdown, and we've actually lost some data, it turns out. We're never going to recreate the November jobs report, I think, or the October report that should have come out early in November. So that's the next step. It's the decay that takes place over time. Now, but from a loss of credibility. That's a separate issue from another data credibility problem I'm much more worried about, which is the decay of corporate America filling out the forms. They're not filling out the forms. We're getting smaller and smaller samples. So the variance is going up and up. And prior commissioners of Bureau of Labor Statistics have been really trying to get people to focus on this problem of getting better compliance with the data collection, because that's where the revisions come in that frankly were annoying the president. President Trump was annoyed by the size of the revisions. Now we always have revisions to the data. So there are 3 layers. I don't think it would be some time before I think you could play through and monkey with the data politically. Those 3 things together are putting a bit of a cloud over the data. Yes. Mm-hmm.
Thank you. Given that recently the Fed stopped the quantitative tightening and they want to start quantitative easing in Q1 2026, do you believe this is a wise decision they're making, or is it something that could lead to problems?
Oh, what a good question. What a hard question. I'm going to, when I said the Fed yet hadn't come up with a post-QE, post-inflation modus operandi, you put your finger on what I'm talking about. So they believe that expanding their balance sheet added to GDP and that shrinking it will detract from GDP. That's actually pretty controversial among a lot of macroeconomists. Now, that's different from the early phases of QE in the financial crisis 15 years ago. You liquefy the banking systems in crisis, you liquefy it. What we called QE2 and QE3, and whether that actually had any impact on GDP growth in it is more controversial. Just printing a lot of money, it's not obvious how that works. They think it did work. So given their view, they think they've got to stop quantitative tightening at some point. Now, part of this problem, I think, is they have to vindicate. They thought it worked the first time, so they have to think it's now tightening. There's a much subtler point, which is inside the government bond market, which we've seen several times in the last 5 years, acute strains in our repo market. The market for, I lend you money and I give you US Treasury securities, you're secured, so we swap treasuries for cash, the repo market. And that market doesn't seem to work very well in times of stress. And that seems to be what the Fed is responding to. Now, that doesn't have much to do with GDP. This is inside baseball, inside the money markets. A long time ago, when I ran the Fed's balance sheet, frankly, it was the last time, we had very small amounts of reserves in the banking system. And the banks were very efficient at recycling it because there wasn't much of it. We didn't pay interest on it. It was a hot potato. If they held it at the end of the day, they earned no money on it. But if I could lend it to you right before the end of the day, you would pay me something for it. So they had very sophisticated systems for trading Fed funds, bank reserves. And it was very efficient. It was huge velocity in this market. Today, the Fed has ballooned its balance sheet. There are vast quantities of reserves in the banking system, and they don't invest anything and have anyone trading because most of the time nobody needs to care. They get paid interest on reserves, and they have huge quantities of them. So why would I pay some trader a lot of money to trade Fed funds if I can just sit on them at the Fed and get paid? Now there's a problem. When you get an awkward distribution of reserves, and some bank is short today and some bank is long, but neither of them have anybody watching, the only place they can go is to the Fed to borrow money. And we call that seeing a spike in demand for the Fed's repo facility. So the large balance sheet the Fed has engineered since QE has reworked the pipes of our money market so it all runs in and out of the Fed every time anyone needs money. And everyone gets all squiggly about interest rates are jumping around. Now, this may be more inside baseball than you want, but 30 years ago, I can recall more than one occasion, but one in particular, where at the end of a quarter, I screwed up. We didn't put enough reserves in the banking system. And then banks had a maldistribution of them, and interest rates went to 25% overnight interest rates at the end of a quarter. Nobody cared. Alan Greenspan thought it was funny. He made me explain how I'd screwed up. The FOMC didn't care. Nobody thought it impinged on the intelligence or credibility of the Fed's monetary policy. They knew some guys in New York had a bad day. So there's something really weird about the Fed they've decided they don't care about the efficiency of the money market. And yet they're acutely sensitive to rates when they bounce around because of noise inside the banking system. So I'm giving you all the dirty laundry on when I say they haven't quite figured out what their post-Q regime is. I mean everything all the way down to including this. And so just to end with the lesson, the government securities market is like an exchange rate between a thing called a US Treasury and a thing called a Fed fund. And if half that market is not very efficient, the exchange rate isn't very efficient either. And I'm afraid that's where we've ended up. But they don't want to talk about that. So they're going to stop QT, as they think of it, and leave themselves with a big balance sheet, really pretty big, and there we are. Anyway, that was more than you bargained for, I suppose. Anyway, another question up here. Yes.
Hi. My question is kind of a two birds with one stone question. So you mentioned inequality before in the economy. So if you were trying to tackle one cyclical problem, so let's say inflationary environment, and also income or wealth inequality, some form of inequality in the US, if you are sitting in Congress, you can be relatively surgical with the fiscal policy and say, for this income bracket, this wealth bracket, we're going to tax at this rate. Is there a way that the Fed can be as precise with monetary policy to address both a cyclical concern like inflation and a longer term concern like inequality?
No, the Fed really, we like to say monetary policy is a blunt instrument, and the Fed can have very little impact on inequality per se. That is, can the Fed do something? Now, you can sort of create a story. I don't mean a false story, but we could make credit more available to people of lower incomes, and that's the sort of tool you would see coming from the Fed and the banking system. I'm not optimistic about that to make a real dent in income inequality in America. Lending money to people who can't afford to pay you back is not much of a recipe for addressing income inequality. So no, Congress has the more precise tools, and the Fed really doesn't when it comes to problems like income inequality.
So we're just about out of time, Peter. And in wrapping up, I was hoping that you could answer one last question, which is, we've got all these students here thinking about their careers and getting off in various different sectors in the environment where it seems like we are going to have an extended period of this kind of untethered fiscal policy. Any advice for how they ought to be thinking about this and how to manage their careers in this kind of a crazy macro economy? I mean, there's untethered and then there's unhinged. And so what do we do?
For ourselves, that's a tough one. My brother has thanked me, even though my life has been spent figuring out how to invest. How many bonds, how many equity, how much volatility, how to diversify your portfolio. But years ago, I told my brother, who's a medical doctor, pay no attention to that, just save a little more. Now, that's contra to what we normally want the economy to grow. We want to consume more. But save a little more. Not a lot more. I don't mean to be nervous, Nellie. I mean, you're going to do well relative to the population as a whole in the United States, but save a little more. And that's And Kent Smethers at Wharton, who's an old friend, also likes to tease me about that. Is all the stuff you do at BlackRock, Peter, it has no bearing on how well people do in life. It's just to get them to save a little more. And so I think that's one piece of advice I give. I give another piece of advice, which was the most extraordinary piece of advice I got as a young law student. And I'll tell the story when I teach in the spring, and I'll tell it to you right now. I was invited to lunch as a young law student by one of the most senior lawyers in Boston. He was a friend of my family's, and he was a wonderful man, the dean of the legal community in Boston. And I was panicked. I do not want to be a trust and estates lawyer. Even though he's a wonderful man, I don't want to work for him. So I don't know why he's inviting me to lunch, and I was terrified. And his daughter was a friend of mine. I said, "Why is your dad taking me to lunch?" He said, "You're a big boy. You can go figure it out, Peter. He won't bite your head off." And partway through lunch, it became clear. He said very bluntly, "Peter, you know, there are a lot of smart kids at Harvard Law School, and they're going to make a terrible mistake. They're going to think they have to give up what they want to do with their life in order to make enough money. And we're not going to let you make that mistake, because I think you're clever enough to figure out what you want to do with your life that will pay you enough to live in whatever style you want to live in. And you're in charge of both those things, aren't you? So we're not going to let you get away with that. You're going to figure out both sides of that equation. You're going to figure out what you want to do that you like, and whether you want to live in a 1,500 square foot apartment or a 10,000 foot house in the suburbs. You're in charge of both those things. No one's going to tell you what to do other than you. And, you know, I don't think I would have had the courage to go to work for the Fed at about 30% of the salary that I would have gotten working for a private law firm. He said I was in charge of both those choices. And my first apartment in New York City, I assure you, was not 1,500 square feet. It was a lot smaller. And so that's the best piece of advice I ever got.
Wonderful. Well, please join me in thanking Peter Fisher for this.
Thank you all. Andrew, thank you so much.
Thank you all for coming. Wish you all a very happy Thanksgiving. We have a lot to be thankful for. We'll see you all back after that. Thank you.